Welcome to this special edition of Money Matters, where we dive deep into the latest developments in the world of finance. Today, we'll be discussing the recent increase in the repo rate by the Reserve Bank of India, and what it means for us. Before we dive into the details, let's first understand what the repo rate is and why it matters. The repo rate is the rate at which the central bank, in this case the Reserve Bank of India, lends money to commercial banks in the event of a shortage of funds. It serves as a benchmark for interest rates and is a crucial tool for the central bank to control inflation and maintain monetary stability in the economy. So, what led to the increase in the repo rate? The main reason behind this increase is the current inflationary trends in the economy. The RBI has stated that the inflation rate has been higher than expected, and is expected to remain elevated in the coming months. To control this rise in inflation, the central bank has decided to increase the repo rate by 25 basis points, taking it to 4%. Now, you might be wondering, what does this increase in the repo rate mean for you? Well, the impact of the increase in the repo rate is likely to be felt by borrowers, as banks are likely to pass on the higher costs to customers in the form of higher interest rates on loans. This will make loans more expensive for individuals and businesses, potentially leading to a slowdown in spending and investment. But, it's not all bad news. The increase in the repo rate is a necessary step to control inflation and maintain price stability in the economy. In the long run, this will lead to sustainable growth and a more stable financial environment. Additionally, for those with fixed deposits, this could lead to higher interest rates on their savings, providing a boost to their financial security. Now, let's talk about the implications of the increase in the repo rate on various sectors of the economy. For the real estate sector, higher interest rates could lead to a slowdown in demand for housing loans, potentially affecting the growth of the sector. On the other hand, the increase in interest rates could benefit the banking sector, as higher interest rates mean higher returns on their investments. The impact on the stock market is a mixed bag. On one hand, higher interest rates could lead to a slowdown in economic growth, which could have a negative impact on the stock market. However, higher interest rates could also boost investor confidence in the market, leading to increased demand for stocks. Let's take a closer look at both of these aspects. When interest rates go up, it becomes more expensive for individuals and businesses to borrow money, leading to a slowdown in spending and investment. This, in turn, could lead to a slowdown in economic growth, which could have a negative impact on the stock market. However, higher interest rates could also increase the demand for stocks, as investors look for alternative investment options to earn higher returns. Additionally, higher interest rates could boost investor confidence in the market, as they signal that the central bank is taking steps to control inflation and maintain monetary stability in the economy. It's important to note that the impact of the increase in the repo rate on the stock market could vary depending on the sector. For example, the banking sector, which is directly impacted by changes in interest rates, could see an increase in demand for its stocks, while the real estate sector, which is sensitive to changes in interest rates, could see a slowdown in demand. In conclusion, the increase in the repo rate by the RBI is a necessary step to control inflation and maintain price stability in the economy. While it may lead to higher borrowing costs for individuals and businesses in the short term, it is a measure aimed at ensuring sustainable growth in the long run. We hope this special edition of Money Matters has been informative for you. Stay tuned for more updates and insights into the world of finance. Thank you for tuning in.